Hello, dear learners. Hope you identify this logo. Yes, this is India's central bank called Reserve Bank of India. Central bank is a very important institution in a modern economy. Almost every country has one central bank. India got its central bank in 1935. Its name is the Reserve Bank of India. Before we discuss, I want to ask you few questions. Let me know that which institution control money supply in India? Yes, this is RBI. Do you know that how money supply controlled by RBI? Yes, dear children, RBI framed monetary policy. Is there any committee to framed monetary policy? Yes, dear learners, there is a monetary policy committee comprises 6 members. Is there any tools to control money supply? Yes, there are various tools. Dear learners, today we are going to discuss policy tools to control money supply. The RBI controls the money supply in the economy in various ways. The tools used by the central bank to control money supply can be quantitative or qualitative. Let us see the qualitative tools: CRR, SLR, repo rate, reverse repo rate, bank rate and open market operations. Qualitative tools: moral suasion, margin requirement and rationing of credit. Let us discuss tools one by one. CRR. The RBI decides a certain percentage of deposit which every bank must keep as reserve. This is done to ensure that no bank is overlending. Dear children, this is a legal requirement and is binding on the banks. This is called the required reserve ratio. Remember, or the reserve ratio or cash reserve ratio. How we define the cash reserve ratio? Percentage of deposit which a bank must keep as a cash reserve with the bank. Let us assume an example. Suppose CRR is 20%, then deposit of rupees 100, our bank will need to keep rupees 20, 20% of 100 as a cash reserve. Only the remaining amount of deposit, that is rupees 80, can be used to give loans. Dear children, now we are going to analyze two different situations in an economy. In an inflationary situation, RBI when increases CRR, it means that commercial bank have less money with them. Thus, they increases interest rate for various type of loan. Due to interest rate hike, demand for loan decreases. People have less money to buy some goods and services. This will resulted money supply in control in an economy. Let us discuss the second situation. In a deflationary situation, RBI decreases CRR. It means that commercial bank have more money to expand their loan for various business activity. In a deflationary situation, interest rate decreases by the commercial banks. This will resulted more money supply with people, thus demand for goods and services increases. Second tool, statutory liquidity ratio. Banks are also required to keep some reserve in a liquid form. In the short term, this ratio is called statutory liquidity ratio or SLR. To control money supply in inflationary and deflationary situation like CRR, the same steps taken by the RBI. Next tool, third, repo rate. When the central bank buy the securities, this agreement of purchase also has a specification about date and price of resale of this security. This type of agreement is called repurchase agreement or repo. The interest rate at which the money is lent in this way is called the repo rate. Let us understand in a very simple manner. RBI lends money to the commercial banks against securities. In case of commercial bank have less funds, let us understood the impact of repo rate. Dear children, again in an economy there is an inflationary situation or excess demand. RBI increases repo rate, it means that commercial bank have less money with them. Thus, they increases interest rates for various type of loan. Due to interest rate hike, demand for loan decreases. People have less money to buy goods and services. This process are resulted money supply in control in an economy. Dear children, in a deflationary situation, there is a deficient demand. RBI decreases repo rate. It means that commercial bank have more money to expand their loan for various business activity. In a deflationary situation, RBI decreases repo rate. It means that commercial bank have more money to expand their loan for various business activity. In a deflationary situation, interest rate decreases by commercial banks. This will resulted more money with people, thus demand for the goods and service increases. Tool number 4, that is reverse repo rate. Dear children, the central bank may sell the security through an agreement which has a specification about the date and price at which it will be repurchased. This type of agreement is called a reverse repurchase agreement or reverse repo. Or, dear children, we can say that when RBI borrows money from commercial bank for short term, there is a short term rate called reverse repo rate. The rate at which the money is withdrawn in this manner is called the reverse repo rate. The Reserve Bank of India conducts repo and reverse repo operations at various maturities. For the overnight, 7 days, 14 days, 91 days, etc. This type of operation now become the main tool of monetary policy of the Reserve Bank of India. Dear children, now we discuss tool number 5, bank rate. The RBI can influence money supply by changing the rate at which it gives loan to the commercial bank. This rate is called the bank rate in India. Remember, dear children, it is different for the commercial bank interest rate. By increasing the bank rate, loans taken by commercial bank become more expensive. This reduces the reserve held by the commercial bank and hence decreases money supply. A fall in the bank rate can increases the money supply. This type of steps taken when economy facing deficient demand. Dear viewers, there is another tool, open market operations. Let us understand this tool. Open market operations refers to buying and selling of bonds issued by the government in the open market. This purchase and sale is entrusted to the central bank on behalf of the government. When RBI buys a government bond in the open market, it pays for it by giving a check. This check increases the total amount of reserves in the economy and thus increases the money supply. This type of activity done by the RBI in deficient demand situation. Dear children, selling of a bond by RBI to private individuals or institution leads to reduction in quantity of reserves and hence the money supply soaking by RBI from the market. This type of steps taken by the RBI in excess demand situation or inflationary situation. Dear children, so these are the quantitative tools. Now, we are going to discuss qualitative tools. Number 1, moral suasion. It is necessary to follow monetary policy directives. In inflationary situation, all commercial bank approved loan in disciplined manner. In deflationary situation, more loan approved by the bank. Dear children, there is a tool number 2, that is a qualitative tool, margin requirement. This is the minimum down payment that borrowers have to arrange for as per percentage fixed by the commercial bank for their total borrowing from commercial bank. Let us understand the example. Assume your father wants to buy a car. The value of car is rupees 5 lakh. He approaches to the bank for car loan. The bank asks him to deposit rupees 1 lakh as minimum down payment. The amount rupees 1 lakh called margin requirement. Dear children, let us move to qualitative tools number 3, that is rationing of credit. The RBI fixed the credit quota for business activities. This will help to control money supply in the market. During inflation, commercial bank granting or approved loan in very strict manner, and in deflationary situation, commercial bank allowed to approve more loan. Thus, money supply control in the economy. Dear learners, now you know how money supply controlled by the RBI. In an inflationary and deflationary situation in an economy. Dear children, you may see that how RBI controls money supply through its various tools in an economy. Let us quickly check the current ratio and current rates declared by RBI. Recently, Monetary Policy Committee reviewed the rate on August 10. Below table is taken from the RBI web www.rbi.org. For more details, you visit the RBI web. See the table. Dear children, hope you enjoyed the topic. It's helped to understand how interest rate up and down on point basis. Sometime there is a no change in interest rate. This will help to understand how interest rate affect home loan EMI or car loan EMI. This will due to various tools of monetary policy. Dear learners, you understand the topic very well. Surely we will meet in the next session. Keep learning. Till then, goodbye and thanks.